One of the companies that I own is Ternium. It's a steel producer predominantly operating in Mexico as well as South America. I bought them a few years ago because they provide the steel that auto companies need, as well as other manufacturers in Latin America, as well as the United States. Their proximity to the US, I thought, was a big advantage, and it's been a good holding. They pay a really high dividend and have been profitable every year that I've owned them. They released their earnings today, and I've updated my valuation for Ternium, as well as evaluated their performance based on their full financials for 2022. Let me take you through that. I scorecard all my investments and try to stick to the same process as I value companies in making a decision whether I should buy more shares, hold my position, or sell all the shares that I have because I no longer want to be an owner of that company. It involves 4 questions followed by an action item. The first question: is it an industry I want to be in? Is the company operated and performing well? Is debt less than 3 times EBITDA? And I want a discount on the stock. That way I could see my investment go up in value. Based on the answers to the questions, I will either buy, hold, or sell my position in a particular investment. The steel industry is cyclical. Prices for that commodity go up and down, and this industry has enjoyed good prices over the last few years. They did drop in 2022. They dropped maybe 20%, and that really affects steel producers. Ternium operates predominantly in Latin America. Their biggest operation is in Mexico, second biggest Argentina, then Brazil, and they have 5% operation in Colombia. They also produce about 8% of their steel here in the US. So a very Latin American-based company using the advantage of less expensive labor in those regions. And I think it's easier to operate a steel company as well in those countries as opposed to the US. Ternium announced their earnings today for full year 2022, and the results were good. I really like that they kept their revenue stable. They actually grew 2% because they had more volumes go out. Prices did go down, but they maintained that revenue line. Their cost was higher because they produced more steel to get the same amount of revenue. But I like that they maintain their profitability. It shows that the company is operated well. Ternium has a solid balance sheet. Inventories have been going down, which is good to see. Their cash has gone up, very good to see. And their debt has been going down. So all 3 things look good. Their statement of cash flows was also in really good shape. They produced a lot of free cash in the form of their cash from operations less CapEx. You see that it was quite stable. Even though they were less profitable, they generated about the same amount of cash from operations, and their CapEx didn't increase a whole lot. They have more than enough out of their EBITDA to pay their dividend. It's a very low payout ratio, so I expect that the high dividend will continue in 2023. And with all the cash that they're producing, they're also paying off debt. So it's good to see that they're paying off more debt than they're borrowing. So their net borrowings have been going down over time. I value companies based on free cash flows that I expect in the future, discounted in today's dollars. And what I've done is I've taken the free cash flows that they produced in 2022 and reduced them by 50%. And this industry is cyclical, so prices could continue to go down. It's not expected that they go down, but I want to make sure I'm conservative. That leaves me with half of their free cash flow they produced in 2022 as a starting point in my model. I'm not going to grow the first 4 years of cash flows. That way it could be nice and conservative. Long-term growth, I'll grow at 2%. And my weighted average cost of capital is going to be 11%, which is a high number, mainly because it's an international company. So I'm going to give it a higher risk weighted average cost of capital, but their balance sheet's in great shape. So based on those factors, the value of the company is $10.8 billion, but their market cap is 7.6. So it offers up a nice 41% discount on the stock, giving me a nice discount on a stock that pays a really high dividend, almost 7% dividend. It's a pretty safe dividend. Their debt to EBITDA, excellent. It's only 0.2. I'm looking for 3x or less. These guys pretty much can pay their debt off with cash on hand or in several months of performing or producing their EBITDA. So to summarize TX, their performance was very good in 2022. They maintained their revenue. They actually grew by 2%, even though steel prices had dropped. So it's good that they were able to produce higher volumes. Their PE is incredibly low, 2.73%. They generated $2.1 billion of free cash flow, and they have a market cap of $7.4 billion. So look at all that free cash flow in comparison to their market cap. It's just a very good ratio. They produce a free cash flow yield of 14%. They pay a very high dividend, 6.9%, and it's about a 16% payout. So they can more than afford that dividend. For 2023, steel prices are expected to go up, but I'm not banking on it. My model, I'm keeping it conservative. The company, I believe, is performing really well. You could tell because they were able to produce really high volumes of steel, even though we were dealing with a pandemic and all the complexities with supply chains. The recession will limit their growth. I don't know how much the recession is going to show up this year, but I have that on my mind since it is a steel manufacturer. If people aren't buying cars and appliances and other things that consume steel, it could limit the growth for Ternium. My long-term outlook is this is a well-operated steel company, and they pay a really high dividend that I automatically reinvest in the stock. So I continue to be a larger shareholder of the company, even though I'm not putting any more money into the company. They have very good upside in the stock, especially if steel prices go up. If we have any kind of steel shortage, they become very profitable. This is a cyclical industry, and in the next 3 to 4 years, we will see high steel prices. It just goes up and down. Right now, we're closer to the bottom than we are to the top of steel prices. So owning this stock long term is a good idea. So when the high steel prices come, I could participate in the high profits for this company. So let's scorecard Ternium. It's an industry I want to be a part of. I've profited in the oil industry, and I wanted to look for another industry that resembled the oil business. And I felt that the steel industry and the mining industry resembled it because they deal with commodities. And it is an industry I want to be exposed to and have good diversification. This company, I believe, is operated really well. Their balance sheet is excellent. There's a discount available on the stock, even if you have a very conservative valuation like I just showed you. So I continue to buy Ternium. I have a big position in Ternium. We'll continue to buy more shares. Thank you for watching the video. I really appreciate it. I enjoy recording videos of the companies that I invest in, going through my analysis and my decision-making as I either continue to buy shares, hold, or sell my shares. I've really benefited from all the other YouTubers online. So it's good to put my videos out there so other people can see my point of view, and hopefully you found it interesting. Keep in mind, I'm not a professional, so I'm not recommending that you buy Ternium. I'm just recording my experience as a stockholder. And again, I hope you enjoyed it. Good luck investing in 2023.